In this video, I would like to talk about the 4 levels of risk. This is an extract from the latest letter of Giverny Capital, François Rochon. I made a video about François a couple of days ago, and in the latest letter to shareholders, he highlights the 4 key risks we face as investors. And this is really important and not often talked about. So here is the video for you. In this video, I will read this document and I will comment on it. So it will be a short video. You will get a lot of value so you can do something else with your day. Okay. In my view, any investor's stock portfolio has 4 distinct levels of risk. Portfolio diversification, the quality of the companies held, the stock market valuations paid, and lastly, the investor's own behavior. You see, he doesn't mention tariffs, macro, speculation, macro hedging, commodities. No. The first thing is portfolio diversification. Our experience and analysis. By the way, if you don't know who François Rochon is writing this letter, he's a Canadian investor that has averaged 15% per year for 30 years. So he has outperformed the S&P 500 for 30 years. He is one of the best investors you can find out there, and he manages a portfolio called Giverny Capital. So you can type on the internet Giverny Capital if you want more information. Our experience and analysis show that a portfolio of 20 or so securities considerably reduces the risk of having too much concentration in a few securities. This is a figure that represents a good balance between having enough securities to obtain a greater probability of doing better than the average, while having a reduction in the risk associated with too much concentration. I know that I use this principle quite often. I have a portfolio of roughly 15 companies in my portfolio, so this is fairly good. If you have too many companies in your portfolio, like let's say you have 80 companies in your portfolio, 80 stocks, it will take too long to analyze them all. To monitor 80 companies, it's almost impossible. It will take too much of your time to follow a lot of companies. So stay focused with your best ideas. Obviously, some of the greatest investors in history have often owned only 5 or 6 stocks. Yeah, this is Charlie Munger, only investing in 3 or 4 companies for many years, and he has done wonderful, and it has been very successful. However, in these cases, the selected securities had a very low level of risk with respect to the other parameters below. That's right. For example, before he passed away, Charlie Munger only had a few names. He was invested in Costco, in Berkshire Hathaway. But Berkshire Hathaway is a big conglomerate that owns hundreds of companies. So it's as if you owned a fund that was diversified enough. He owned, Charlie Munger was invested in the Lilu's partnership. So Lilu's portfolio. Inside Lilu's stock portfolio, you already have diversification, and they own some real estate. Do I forget something else? BYD? No, Daily Journal a little bit. It was the key investment ideas. So in his last years, Charlie Munger only had 3 or 4 stocks in his portfolio. But within this portfolio, each stock had a certain amount of diversification. On the other hand, having 5 or 6 stocks all in the same sector, so, for example, high tech, does not, in our opinion, represent adequate diversification. Oh, by the way, this is a new mic. I have to... Okay, let me change this. I don't know if this will change something, actually. Okay. The quality of business. So that was the first level of risk, diversification. Don't own too many stocks, like 80 stocks is too much. But at the same time, you don't want to only own 2 stocks because you can never know when you will be wrong. This is also a certain level of integrity and honesty and staying humble in this game. If you only have a portfolio of 2 stocks, if you fail at once, if you fail in your analysis, you have a 50% lose rate, which is not good. So I believe in the thesis of having only 10 to 15 stocks in your portfolio. I think that's more than enough. And you can diversify intelligently, smartly across different industries or different countries. So the second point, the second level of risk is the quality of businesses. This is the most important parameter for reducing the risk of an equity portfolio. There are several characteristics that are hallmarks of a high quality company. First, the company achieves strong returns on equity while maintaining a low debt level and using conservative accounting. A high level of debt and or aggressive accounting increases a company's inherent level of risk, especially during more difficult economic times. Absolutely. You don't want to get margin called when you have a bad time. You don't want a lot of debt when you are hit by the great financial recession in 2009. A quality company also has a sustainable competitive advantage, a moat, that allows it to maintain better returns on its capital over the long term when compared to its competitors. You can check, there are some companies that have a ROIC, a return on invested capital, above 15%, and they have been able to sustain this high ROIC for 10 years. It shows that they have a moat. You only want to invest in quality companies with high returns on capital. In addition, its business model is durable and will therefore prove to be immune to the various transformations, technological or otherwise, inherent to our capitalistic world. Yep. If now you don't have a lot of this that is talked about in our world. You have the Magnificent Seven, Facebook, Amazon, Google, Apple that are here to stay, Netflix, and they are here for good reason. They are very profitable and very efficient. But it was not always the case. If you look at past decades, the biggest companies didn't stay at the top for 10 years, for 15 years. That's a very recent phenomenon that we are having, because the companies we have in the Magnificent Seven are hungry for more, and for the moment they are not complacent. So they are attacked by competitors and improve, something we didn't have for many big companies in the 70s, for example, in the 80s, for example. So yeah, the world is capitalistic and moving a lot, and with the internet you will have a faster competition, a faster capitalism in our world. So you want to be hungry for more, and if you have a moat that helps you, if your company is better than competition, if you have a sustainable competitive advantage, that's better to survive. The faster the pace of change in an industry, the greater the risk that a company will miss a critical inflection point. Absolutely, absolutely. You have countless examples of companies that were complacent being at the top, and they were completely eaten by competition. In 5 or 6 years. By the way, if you're looking for a complete framework to analyze stocks and build a strong portfolio, I have a coaching program. More on that at the end of the video. Okay, the third level of risk, stock market valuations. It is normal for a quality company to trade at a premium to the average company, as measured by the PE ratio. However, the higher the premium, the greater the risk. A company that trades at 40 times earnings, all other factors being equal, is necessarily riskier than another similar security that trades at a PE ratio of 20, at 20 times earnings. The greater the number of securities in the portfolio that trades at high ratios, high PE ratios, the greater the risk of the portfolio. Obviously, if you only buy companies that are expensive at a PE ratio of 50, 60, 70, you will be disappointed. Ben Graham stated that the key to intelligent investing is the margin of safety. Being conservative in our analysis of a company's future potential and therefore its estimated value is therefore an important ingredient in reducing risks. Yep, you want to invest in great companies, but you don't want to pay up too much for these companies. So yes, you can maybe pay up a PE ratio of 30, 35, but don't go too much. Don't go too high. Don't buy a quality company if the PE ratio is 80. That's a lot. For example, I have an example for you. You have Fair Isaac, a company that I love. Ticker symbol is FICO, FICO. Check it out online on the internet. It was trading at a PE ratio of 100 not a long time ago, a couple of weeks ago. And the fourth level of risk is the investor's own behavior. I have written this many times, but it is vital. The best investment strategy is futile if one tries to predict the stock market. The level of risk of a portfolio is thus linked to the period of holding of its securities. The longer the holding period, the greater the probability that there will be a correlation between the stock market performance and the intrinsic performance of the companies held. Obviously, if you buy something in the very long term, the stock market performance of the stock prices, will have the same growth as the earnings per share in the very long term, like more than 10 years. But in 1 year, everything is possible. In 2 years, unpredictable. You can't forecast what the stock prices will be. But in the very long term, businesses follow stock prices. The stock prices will follow the intrinsic value growth of a business. Conversely, the more an investor trades in the short term, the more the risk of the portfolio increases. Yep. In the 50s, the average holding period for a stock on the New York Stock Exchange was 8 years. It is 8 months today. And yeah, it's the end of this screenshot. Our average holding period has been a few years for Giverny, which is fine. So you are here for the long haul, for the long term. I don't think you watching this video are trading. This is the reason why you subscribe for this YouTube channel. You plan to buy great companies, do the good work, analyze businesses, and buy them at the good price, and then wait a couple of years, at least 2 or 3, 5 years before selling a position. So that's it. And if you follow this key level of risk, the 4 key levels of risk, you cannot fail. And you see they didn't mention macro, interest rates, inflation, the Fed, quantitative easing, international tensions, going into international markets. No. You just follow these key principles and you make a lot of money. You focus on the right assets, the right companies, you pay a good price, you keep your emotions in check, and you believe in the thesis of long-term investing. So sometimes investing is quite simple, and that's the hardest part for a lot of investors, to sit still and do nothing. But that will be the topic for another video. Okay guys, it was a quick video. I hope you liked it, and I wish you a nice rest of your day. If you like this content, I have an investing coaching program. In this program, you will learn a complete investing process. You will learn how to find good stock ideas, how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio. Additionally, you will have access to my personalized guidance for long-term results. We will do weekly calls where we analyze stocks together, and you will have access to my private number available 24/7 for full support. If you are blocked, if you have any questions, I'm here to help. Click the first link in the description to get more information. You will get a video that explains how everything works completely for free. No need to sign up, no need for your email address. Just click the first link in the description and I'll see you on the other side.